Hi, my name is Kyle Wiggs with Exact Strategies. We're really in step 4 of the client sales process. Step 1, as a quick reminder, was to use the volatility as relatively stable piece and to ensure the clients that we're making through technology objective investment recommendations by forcing investment companies to compete. In step 2, we went through the analogies piece to help clients really understand in their own words how it is that our technology works. And in step 3, we went through the process piece, which talks about the 6 steps to what we believe creates a better client outcome for both the alpha and beta mode portfolios. Now we're going to talk about in step 4, so how is it done? This piece is going to give you an overview of Exact Strategies and all of the advisors that we serve. Keep in mind that in tandem with this piece, you can if you want, utilize your individual portfolio fact sheets. But in terms of using this piece, what this is showing us is this is showing all of the drawdowns and recoveries dating back to World War II. And so in the light blue lines, those are the individual drawdowns and individual recoveries. And then in the dark blue line, we're looking at the average of all of them combined. So according to Clearnomics, the average market falls 14.3% and takes 4 months to recover. And as we all know, the traditional buy and hold methodology would simply tell the client, stay the course, don't panic. As long as we remain invested and as long as our time horizon and risk are both appropriate, we have some degree of confidence that things should work out. And by now, as you know, Exact Strategies fundamentally rejects that. Whether it's in alpha mode or beta mode, we believe that you should use technology to take action, to not sit by and hope that things don't become another 2008 or 2000. We ultimately want to use the technology to take action and take control. And so if we go to 2018, what we're looking at here in the dark line is the drawdown of the S&P 500 starting in September of 2018 through the bottom, which was in late December of 2018, and then the recovery through 2019. You'll notice on the right-hand side, these are the broad-based asset classes that our technology will make recommendations in our alpha mode portfolios on behalf of you and your portfolios. And so really the takeaway here is relatively simple. We don't know if the next Fed meeting is going to have a positive or negative impact on the markets. We don't know if the Fed is going to raise rates or if the Fed is going to lower rates. We don't know if trade wars are going to ultimately get worked out in the near term or in the long term. But what we are using our technology to do is to observe, because we believe that all of those events are being priced into the investments in your portfolio. Our technology in alpha mode is observing those price movements and asking itself the question, based upon what's happening today, where is the most productive and durable place to allocate capital? And so what you'll notice is as the tweets about China and as the Fed policy meetings started to become less noise and really more kind of material, our technology picks up on that. And in this case, cash or MDI is recommended in the portfolios to replace a lot of the growth and sort of international and value securities that were in the portfolios. And you'll notice that as things got worse and worse, the percentage of cash increased. A couple of things. Our technology is not predictive. Similar to Google Maps doesn't believe that just because it's a holiday weekend, there's an increased probability that there's an accident on the freeway, so you should avoid it. Google Maps also doesn't say because there was an accident on the freeway last week, you should avoid it. It is observing current conditions and making appropriate recommendations. Our technology is not predictive. It is not simply saying there's a Fed meeting at the end of this year, so we should take action now. What we're looking to do, we will not avoid every little hiccup in the market, but as these hiccups start to potentially become much more severe, that is where we have a desire for our technology to react and take action. And you see that represented by the large number of cash signals across all of our advisors in the fourth quarter of last year. As all of you know, when cash is introduced into a portfolio, it does so sleeve by sleeve. The importance of that is we do not simply make recommendations that if the market's down X, we move all to cash and we wait until it comes back to Y. Every day that a sleeve owns cash in the portfolio, the technology reruns the algorithm and says, is cash still better than the options available to me? The benefit of that to you and your clients is that, as you can see here, as the markets quickly started to recover, these cash signals virtually went away, and you stepped back into the opportunities that were presented in the marketplace. So in using this piece with clients, it's an acknowledgement that the markets go up and down, but rather than simply saying, stay the course, we hope this works out, we want to use technology that simply gives us the highest probability of protecting in periods of distress and capturing periods of opportunity.